Hi, Peter Kim, Chief Investment Officer, Brandywine Oak Private Wealth.
And I'm Michael Henley, the CEO and founder of Brandywine Private Wealth. We're going to go through today our firm's investment philosophy and really talk about the intersection between what matters in the market and what we can actually control. So Brandywine Oak Private Wealth employs a goal-oriented family wealth plan, which serves as the blueprint for investment recommendations made to clients. We believe that all successful investing is goal-focused and planning-driven, while all unsuccessful investing is market-focused and timing-driven. Our philosophy is to own all of the great companies of America and the world in the most cost and tax-efficient manner, while taking the least amount of risk necessary to achieve the family's financial objectives. Fact of the matter is, the family's plan is the starting point. It's not the investments first, it's the plan first. So what's the family trying to accomplish with their wealth first? And how do the investments kind of fit that overall family wealth plan?
Exactly. The investments are a means to the end. They're not the leading takeaway from a financial portfolio. It's
Exactly.
making sure the investments mirror the plan, because the plan is really what's going to drive success.
Yep. I always like to say what the most important question when we sit down with a family is, what's the money for? That is the most important question. We can't do our jobs without knowing the answer to that question first. So take us through this Nobel Prize stuff. It's way above my pay grade. So help us understand what this is all about.
Sure. So part of the key tenet of our investment philosophy is trying to own everything in the market. And the reason we believe that you want to own everything in the market is because we think the market does a pretty good job of detailing to us what the actual value of a company should be. So in our mind, there is no really inherent advantage that I have, or that Michael has, or you have in valuing the price of a stock compared to anyone else in the open market. So for us to say that we have that inherent advantage and we know better than someone else, I think is very short-sighted in the grand scheme of a financial portfolio. So we try to own everything in the market in their general market weights, because over time that's been shown to actually have the best return consistently year in and year out.
Love it. So I think what you're saying, Peter, is basically that our firm here in Kennett Square, Pennsylvania, is not going to have inside information about any company, over and above what's already out there.
Correct. You're absolutely right. No one is going to have any outsized information that is extra to what anyone else has in the public markets. So in our mind, if everyone has the same information, then you don't have an inherent advantage. So you can't really tactically adjust a portfolio to take advantage of that inefficiency.
Makes sense. And I would imagine if you buy the market, if you buy the entire index, you're always going to capture the winners.
You're exactly right. That's why we like to own everything, because no matter what you own, then it's guaranteed to own all the winners. And that's how you can really drive compounding success with our portfolio. So this is a proof of concept, right? So this is collectively, we know more than any one individual. And this is done with that classic jelly bean study where you go to a conference and they say, how many jelly beans are in this jar? Take a guess. Closest person wins, a coupon of some sort. So this was done at a place called Dimensional Fund Advisors. They asked all the advisors there to guess how many jelly beans are in the jar. And as you can see, it's a pretty wide range. However, when you look at the average and the actual amount, they're pretty close. So it helps paint the picture that collectively, we do know more than any one individual person. And while some people probably did guess very close to what the actual number is, the average over time, when you look at large numbers, does actually then generate some return for you and gets us very close to an intrinsic value of what you're looking at.
Makes sense. So I guess markets are efficient.
Absolutely. That's the point of them. There is no inside information that you can really take advantage of without doing some insider trading. Modern portfolio theory, kind of the dawn of asset allocation, or the fancy word is mean variance analysis. And basically, what Markowitz found was that if you pair different asset classes together, for example, stocks and bonds, you actually get a better risk-adjusted rate of return compared to just owning one type of position in a portfolio. So by pairing different asset classes that have different return cycles, you actually get a better risk-adjusted rate of return of the portfolio over the long term. A crude way to think of this is how much bang for your buck are you taking for the amount of risk you're taking in the portfolio. And this is a way to maximize that efficiency, so you're not taking outsized risk for less than outsized returns.
Got it. So I guess an example of this would be like in 2008 when the stock market was down 50% or what have you, high to low, treasury bonds were up 10, 15%. I guess by having treasury bonds in your portfolio, you have something that's kind of a ballast or that will actually perform well when the market's falling apart.
Exactly correct. Because they have different return cycles, they paying off of different metrics. What you're going to find is that they have different returns in any given year, and that can work to your advantage. When one is not doing as well, the other is there to prop it up and help shoulder the load for you. It's narrowing the band of outcomes of what we're really looking for to have consistent returns to tie back to the financial plan.
Love it. Makes a ton of sense. Good stuff. I love this slide. Yeah.
It's really busy though.
It is busy. I'll tell you, it tells the story though. Because especially with risk on the bottom, like we want to be up and to the left, up and to the left.
Yep.
That's the idea. All righty. Benefits of diversification. So talk us through this one.
Absolutely. So we preach diversification. The mean variance analysis shows that when you pair different types of asset classes together, even within the stock market, you get a better return over time. So what this is showing is that over time, if you exclude just the top 10 performers in any given year, making tactical bets of saying, I don't think these are going to be the best stocks this year, you actually reduce your portfolio return by about 5% a year. And if you exclude the top 25% of top performers each year, because you're just not great at picking individual winners in a consistent basis, you actually have a negative return over time. So owning the whole market cuts down on all of that fluff that you don't have to worry about. It's things you cannot control that are really driving the market for you at that point. So for us, it's own everything, capture the market return, what we call the beta of the market, and let that drive the compounding effect for the plan.
Love it. Great stuff. And it's I guess the way to say it would be the market will figure out for us. They'll swap out Blockbuster for Netflix. They'll swap out Radio Shack for Best Buy. We don't have to do anything just by buying the entire market. That's automatically going to happen, correct?
You're exactly right. The nice thing about owning everything in the market is that as the company gets bigger and bigger and bigger, NVIDIA, for example, it becomes a bigger and bigger part of the portfolio automatically. And as the company gets smaller and smaller, say a regional bank, for example, all of a sudden it becomes less and less of an impact on the portfolio. As it's becoming smaller in size, it becomes less and less of the portfolio mix.
Got it. Or like Kodak or Sears, they're just kind of gone by the wayside.
Kodak, Sears, Blockbuster is a great example. All of those companies that at one point were kind of the bellwethers for the S&P 500 even, are all of a sudden kind of an ancillary piece that just does not have the same impact that it used to.
Got it. I guess one question that I'll ask Peter is, why wouldn't we just buy the best performing index then? So the NASDAQ's kind of been on this run for 10 years or so, or a number of years where it kind of has 50%, I guess, are only in 7 stocks. So it kind of has really outsized winners. What are some of the risks to owning like the best performing index, if you will?
Sure. So I think the general statement is past performance is no guarantee of future results here, right? Yep. And that's kind of the point of why we like to own everything. Because while certain stocks or certain companies or sectors may be in favor right now, that's not necessarily always the case, right? The perfect example of NASDAQ, as you said, if you invested in NASDAQ in 1999 and then rode that so you got back to even, it would have taken you about a decade to just break even just from poor timing and concentration risk there. So by spreading out that risk, reducing some of the overall volatility of a portfolio, you get a much more consistent, stable return that you can kind of count on and build around.
It sounds like a couple things. Number one, it's not what you make, it's what you keep when the market falls apart. Number one. Number two, every asset class, every sector has its day in the sun and day in the shade. So we want to be careful not to just buy and try to focus on the day in the sun asset classes, the bottom line.
Absolutely. And it's typically, you always want to try to be front running whenever possible of whatever the next trend is. So if you're always looking at the trend, trying to get into it after the fact, it's typically a losing situation for you over time.
Makes sense. All right. This looks like a busy slide here. And I see an ice tray. Are you investing our clients' life savings into ice trays, or what's the thought there?
Absolutely. It's a very good analogy for how we actually deploy our client assets. In our world, we take the general broad market index, try to own everything in the market. However, we deploy a little bit of a factor tilt to the portfolio. So factors are basically just a fancy way of saying we want to splice the market by a certain trait. So I want to organize the world based on people of height size, right? That'd be a trait that you can kind of invest around. So for us, what has been shown over time is that if you tilt a portfolio, kind of like you have an ice tray, just to one side a little bit, so there's a little bit more water in the one side of the ice tray than the other, what you find is if you tilt towards what's called value factors and the size factor, you get a better risk-adjusted rate of return within the portfolio over long periods of time. So by taking that portfolio that is a standard market weight and tilting it a little bit, and I mean ever so slightly, to value and size premiums, you're improving the risk return profile while at the same time generating market return expectations.
So it almost sounds like more of a Warren Buffett type approach, perhaps? value
Very
tilt?
much so in that we want to have a value tilt. We want to have good quality companies as kind of the bellwether in the portfolio that you build around. I would say the one difference between Warren Buffett is that he at some point looks to get rid of some of his positions. For us, we like to hold them for the long term because we want to own everything in the market in their market weight. So the market can really drive that for us automatically.
Got it. Makes sense. Good stuff. Anything else? I'm telling you what other clients will ask about. They'll kind of use value tilt, so I guess a way to say it would be almost like Procter and Gamble, Johnson and Johnson, kind of just blue chips. I guess the way to think about value is it more just kind of blue chips as opposed to kind of like the high flying latest trend.
Yes, if you were to think of the world and kind of bifurcate it into terms of growth versus value, when you think of high-flying tech stocks, companies that are really focused on kind of their future growth potential and earnings potential, there's going to be more on the growth-oriented side. They're going to be a little more choppy and volatile and certainly see higher highs and lower lows. The value side of the index is honestly kind of the more boring side, right? It's the big blue chip, high quality names. They're probably not going to be the flashiest of names, but are just good quality companies that you want to continue to own kind of in perpetuity.
It kind of goes back to the investment philosophy. Basically, all successful investing is goal focused and planning driven. All unsuccessful investing is timing focused and market driven. It really is just kind of avoiding those trends at the moment. Let me say the sentence slowly. Let's not look at what's working just right now. Let's look at what's worked in all of history, in every single market cycle, not just in the last 1 or 3 years.
Absolutely. You're exactly right. Trying to time the market is always going to be a tough situation because you got to be right twice. You got to know when to get in and when to get out. Whereas if you just own the market, let the market drive that return for you. If the planning has been done correctly, it should not matter what the market does because that's something you can't really control. The planning and upfront strategic adjustments that you make, those are really going to drive that portfolio performance for you.
The course corrections, it makes a lot of sense. The only way to capture all the market ups, last time I checked, is be willing to sit through all the downs. You can't have it both ways. It's just, I guess we're not told in advance either. Is it going to be a little bit of rain or a hurricane? We don't get advance notice.
Exactly right. You can't really forecast how bad it's going to be or how good it's going to be. You can only know what to do in case it happens. And for us, we'd much rather plan ahead and make sure that whatever does come down the pipeline does not affect us or our clients negatively. We've already prepared for it and are ready to go with any solutions.
So let's talk through these various factors.
So when we look at the factors that exist in the market space right now, there's a couple that have some prolonged and pervasive exposures. So when you look at the company size, smaller companies are a little more nimble than bigger companies. Think of it as like trying to steer a jet ski versus a freight liner in the ocean, right? One is much more quicker to adjust and can turn a little bit faster. So it has a little bit more growth potential kind of in that upstart years. So small companies are something that we try to tilt to give us a little bit more growth potential. Value companies are a little more stable, a little bit more secure in their situation than a high-flying growth company. So that brings a little bit of volatility reduction down to the portfolio as well. So by cutting down on some of the volatility, it allows us to take a little bit more of an outsized exposure to company size to generate some extra return there. And by making that adjustment within that ice tray, it allows us to maintain that exposure of owning everything in the market, but at the same time drifting the portfolio so you have a little bit different look and feel to maximize those returns over a long period of time.
Makes sense to me. Let's talk about rebalancing just briefly in terms of, let's just say from time to time we're moving along. I like to see the stock market takes the stairs on the way up, but the elevator down. So down quickly in a hurry, but slowly and steady on the upside. When we have these major market dislocations or major crises, how do we take advantage in client portfolios with opportunistic rebalancing?
Sure. Rebalancing is a very important part of any portfolio success, so we do it very systematically on a normal market environment. However, if there are situations where we have an outsized drop in the market or some added volatility, you can use that volatility to your advantage. You can do tax loss harvesting by swapping out a position that's at a loss with another similar position and start fresh again. So you get to book that loss from a tax perspective, create some flexibility within the portfolio, but at the same time not lose that exposure entirely. The other thing we like to do from a planning perspective, though, is also look at what the tax situation is. Is there an advantage doing a Roth conversion when the market is down from a state perspective? In our mind, that's a huge advantage to take advantage in the market because you're paying less in taxes on a depressed value for tax-free growth going forward. So it's a way for you to shift what the overall look and feel of your portfolio is without doing any adjustments to the investments, just doing it on the planning side.
Love it. And we like to say at Brandywine Oak, our favorite tax rate is 0%. That's that's the end of it. There's no rate lower than zero last time I checked. So so we'll take it. But just on the topic of private markets, I think it's not just for the heck of it, just take 2 seconds on this. Obviously, we want to have exposure, own the entire market, in terms of stocks, bonds, et cetera, risk adjusted. When it comes to private markets, private real estate, private equity, private credit, can those be additive to a portfolio success? Can you just talk about that a little bit?
Absolutely. That's a great question to ask. So alternative investments are a great way to add either alpha to a portfolio in terms of excess return or volatility reduction. And if you think about the way that we preach diversification on the public market side, you want to diversify your public equity exposure, your public fixed income exposure, even your public real estate exposure. Same basic concept on the private side. By diversifying your private real estate, private credit, and private equity exposure, you're building a bellwether portfolio that's good no matter what's going on in the market. You have something that can take advantage of it, but also those alternatives can really help drive some returns for you and generate some excess return if you need it. Or more importantly, in a lot of cases for our clients, cut down on some of that volatility so you don't have a situation where you have it 2008 where the market's in free fall and you have a cash emergency. You have something that kind of helps stabilize the overall look and feel.
Got it. Makes a ton of sense. One last question, we're just going to wrap this up, is let's say I'm an investor. I'm pretty good at picking stocks. I'm very confident able to do this, and I want to hire Brandywine Oak Private Wealth for my spouse, or if something happens to me, I want to have a professional involved or have a professional team involved. Under that scenario, we certainly have clients who have self-directed accounts. Talk about how we control the size of that allocation so it doesn't kind of take over the portfolio.
Sure. So it's a good question to ask because everyone likes to dabble a little bit on their own. So we always account for that. We want to look at your entire portfolio as we are holistic financial planners. But at the same time, we do factor in the fact that there's going to be a little bit of wiggle room within any portfolio for a client because they may make some adjustments on their own and make some trades for whatever their self-directed accounts are. We're acting more as the backstop to make sure that if that is occurring, there's not a big concentration that you're doing that can harm you or harm your estate going forward in case something bad were to happen to that type of concentration risk. We're here to help kind of diversify all of that exposure. And I really like that answer.
No, that's perfect. No, that's great. I would just say basically, so I guess another to say would be, we're not going to ever have a client put 50% of their portfolio on red or black. We're just not going to let it happen, full stop. So I would say that for 5% of the portfolio or thereabouts, 10% maybe give or take, we're not going to let clients bet too much on one or two companies in a self-directed account.
Correct. We always are mindful of concentration risk within any portfolio. So for all of our clients that do have self-directed accounts or inherited positions, that is something we're very mindful of because that can have some accretive effect to the volatility, especially during down markets. So you're absolutely right. We always like to have some concentration risk exposure where we're banding what that looks like in terms of how much weighting they have, and we try to diversify around that as much as possible. So if you have a heavy concentration to one specific sector or industry, we're typically not going to try to double down on that exposure, but more likely we're going to spread that risk out as much as possible and underweight that sector specifically to make sure that you're not feeling the full impact in case there is a downturn in that market.
Got it. So whether it's employee stock, very often DuPont, AstraZeneca, Chemours, maybe not Chemours, but basically with DuPont and AstraZeneca, it's almost like talking about selling some of that stock is almost like getting rid of your eldest child. It's something that they're very attached to that. So something just being objective, not being emotional, not talking through the pros and the cons, the trade-offs.
Absolutely. We're here to help out, answer those questions, give our insight in terms of where we think that company could go and what their hesitation would be in maintaining that exposure, if there is any. But at the other end of the spectrum, it's okay, great. If we want to maintain that, how can we absolve you of some of that risk then and diversify the portfolio around that exposure?
Got it. We're pretty much done. Should I just mention crypto at a high level? Because I think it's unique. I think maybe we can say just a high level, just 2 seconds, not to give a dissertation about this, but basically high level. We've had a number of clients ask Peter over the years, cryptocurrency, digital assets, they're not going away. I jokingly say it's like cockroaches; they just never go away. So Bitcoin, Ethereum, kind of what's the approach that how have we taken cryptocurrency with our clients? For those clients who are okay with a 1 or 2% allocation, a tiny allocation, then we like to say it's like cayenne pepper. A little bit goes a long way. We don't need a lot to really move the needle. So talk us through how we allocate to crypto.
It's a great question to ask because it is becoming more and more prevalent in client meetings and clients asking about what crypto exposure actually could look like and how we deploy that. So because it is a speculative asset class for us still, that is still very volatile. We typically like to say, put that in a Roth IRA account where you can see that exponential growth really kind of grow tax-free for you.
Yep.
So that is one aspect of it. We also like to say, don't let it grow to be so big that it can dominate a portfolio. We'll have a tight band around that portfolio weighting to make sure that it doesn't become an outsized exposure that can negatively impact you in case the market goes in the wrong direction.
So said differently, if I allocate 1% of my portfolio to crypto, and if it goes to zero, it's probably not going to change my lifestyle. But if it grows to 50%, we will have trimmed it back a number. It'll never get to be more than 5%, for example.
You're exactly right. It's enough to have the feel the impact and see the positive benefit, but the other end of the spectrum, if it completely goes to zero, it's not going to be life-changing and detrimental for you. And if it does have that plus 150% return along the way, we've been clipping off profits. So that way it's never being an outside size exposure, but at the same time, you're generating that return and capturing that alpha.